You know that feeling when you're tracking a package on your phone? Like you open the app and you see that little green progress bar?
Oh, yeah, the out for delivery notification.
Exactly. It says out for delivery. And you just feel this, I don't know, total sense of control. You know exactly where your new shoes or your new phone are. It just feels perfectly predictable.
Right, but it creates this really powerful illusion, like it's just a smooth, uninterrupted, straight line from some sterile warehouse shelf directly to your front porch.
But then the bar stalls
Yeah.
or it flashes delivery exception. And suddenly you're painfully reminded that behind that pristine little digital app is just a chaotic, massive physical world.
Yeah, trucks breaking down on potholed highways, unexpected monsoon traffic, just millions of heavy moving parts constantly colliding.
Right. And today, we are cracking open the books on Delivery Limited. They are the absolute titan trying to force India's massive, messy physical supply chain to basically move at the speed of software.
Which is, frankly, the ultimate test of the modern economy. I mean, we expect the physical world to behave like a digital algorithm, and achieving that at a nationwide scale is just staggeringly difficult.
Totally. So we've got a stack of data in front of us today. We're looking at their own Q3 FY26 earnings presentation, a detailed 12-month media and financial analysis, and the real-time stock technicals from Zero to Kite as of right now, April 2026.
It's a lot to go through.
It is. But our mission for this deep dive is to cut through the corporate glass. We need to figure out if delivery is actually modernizing the Indian delivery ecosystem or if they're, quietly collapsing under the sheer weight of their own massive scale.
Right.
Okay, let's unpack this. Evaluating a company like Delivery is exactly like tracking a complex multi-stop package. Sometimes the tracking says it's early, sometimes it hits an unexpected delay. You really have to look at the entire route to know what's going on.
Yeah, and to understand their current trajectory, you first have to look at the narrative they're selling to their investors right now. Because in their latest earnings report, they are essentially taking a victory lap.
I mean, the headline number alone is pretty crazy.
It's massive. They crossed 1,000 crore rupees in service EBITDA in a single financial year for the very first time. FY26 was a huge milestone.
And the physical volume required to actually hit that number is almost hard to visualize. We are talking about moving, 295 million express parcel shipments in a single quarter?
Just in Q3, that was their festive season peak. It's a nearly 43% jump year over year.
Wow.
Yeah, and at the exact same time, their part truckload freight, the PTL segment, crossed 500,000 metric tons.
Wait, explain the PTL thing, because that sounds like a whole other beast compared to just delivering a shoebox.
Oh, it is. That part truckload metric is the real operational flex here. Moving a single parcel is, relatively straightforward. Even booking a full truck for one client is straightforward. But part truckload is a logistical nightmare.
Because you're sharing the space?
Exactly. You are dealing with the mathematical complexity of combining freight from dozens of different clients into one single truck. It requires dynamic routing. So the truck stops at multiple hubs, unloads a few pallets, picks up different pallets, and the software has to constantly reoptimize its route based on weight and fuel efficiency.
It's basically playing a high-stakes, real-time game of Tetris on Indian highways.
That is the perfect way to describe it. And if the algorithm fails, a truck leaves a hub half empty, right? It's burning diesel and losing money with every single kilometer.
Ouch.
So the fact that deliveries stabilize their service levels while pushing 500,000 metric tons of PTL, it shows that their underlying sorting algorithms and their physical hub operations are actually syncing up efficiently.
Which resulted in their Q3 adjusted EBITDA hitting a historic 147 crore. But deliveries isn't just trucks and warehouses anymore, right? Like they're actively trying to become the underlying software of the entire logistics industry.
Oh, absolutely. They've aggressively scaled their SaaS footprint. They're onboarding external clients onto their transport and management system. And they just launched something called Freight Index One.
Freight Index One, what exactly is that?
So Freight Index One is arguably their most aggressive strategic pivot yet, because the commercial freight market in India has historically operated completely in the dark.
Really? How so?
Well, finding out the actual spot rate to move a full truckload from, say, Mumbai to Delhi on a random Tuesday, it usually involves this tangled web of WhatsApp groups, phone calls to brokers, and just relationship-based haggling. Pricing is completely opaque.
So they're essentially trying to build like the Bloomberg terminal of Indian freight.
That is exactly what they are doing. By publishing historical spot prices and algorithmic forward forecasts, they are injecting transparency into this massive, shadowy market.
That's pretty smart.
It's a brilliant move, because once shippers rely on your index for pricing, you aren't just a delivery company anymore, you become the market maker.
Right. And while they are building these software terminals, they're also flying literal autonomous drones. I read they successfully completed a medical delivery field mission using a VPL drone, so vertical takeoff and landing.
Yeah, that was impressive.
It flew 12 kilometers in exactly 12 minutes. I mean, in a city like Bangalore, it can take 12 minutes just to back out of your driveway.
For sure. And it proves they have the technological capability for high-value, time-critical logistics.
But okay, I'm looking at this polished slide deck, right? Record profits, transparent software algorithms, autonomous drones. And I keep coming back to this glaring, deeply human mistake buried in their own regulatory filings.
Ah, yes.
What's fascinating here is that on January 31st, 2026, Delivery had to send a formal letter to the BSE and NSE stock exchanges. The subject line was literally rectification of a typographical error in investor presentation.
A remarkably embarrassing moment for a data-driven tech company.
Right. They had to clarify to their investors that their 9-month FY26 EBITDA was accidentally printed on page 5 as 553 crore, when the actual number was 533 crore. I mean, they made a 20 crore rupee typo on their flagship earnings presentation.
Yeah, that's not a great look. Though, to be fair to their financials, 533 crore is still a massive operational leap from the 257 crore they posted the previous year. So the core growth trend remains intact.
Sure, but a 20 crore slip of the keyboard, it feels symptomatic of a much larger, much messier operational reality.
Oh, definitely.
Because when you step back from that polished slide deck and look at the financial press coverage over the past 12 months, that typo starts to look like a tiny crack in a very strained foundation. The media analysis shows a company that has been violently swinging between massive success and just baffling losses.
The media cycle over the last year paints a very different picture, yeah. It shows a company struggling to digest its own growth. Because Q1 of FY26 was universally celebrated, they hit a record net profit of 91 crore, which was a 67% year-over-year jump. The narrative was, the engine is finally humming.
Right. Here's where it gets really interesting, though. Then Q2 happened.
Yes.
Between July and September 2025, they swung from that massive profit to a brutal 50 crore net loss. And here's the part that defies basic logic. They lost that 50 crore during a quarter where their top-line revenue actually grew by 17%. They crossed 2,500 crores in revenue.
It sounds impossible.
How does a company take on vastly more work, increase its revenue by double digits, and somehow bleed 50 crore in the process? It's like working overtime every day of the week, but ending up with a smaller paycheck.
If we connect this to the bigger picture, this is the brutal reality of the logistics sector. It is a high-volume, hyper-low-margin blood sport. You are literally making pennies on every single package.
Wow, pennies.
Yeah. And to understand that 50 crore loss, you have to look at the underlying mechanics of what they were trying to execute during Q2. The primary culprit was the e-com express integration.
Right, because merging two massive logistics networks isn't just about, painting the trucks a new color.
Far from it. It's an operational nightmare. Imagine trying to splice two massive high-speed conveyor belts together without dropping a single package. You have two completely different warehouse management systems that suddenly need to talk to each other.
And what happens when they don't?
Well, when an Ecom Express barcode hits a delivery scanner and the API throws a 404 not found error, a physical human being has to stop the line, manually key in the data, and suddenly a truck is delayed by 2 hours.
And I imagine those delays just compound instantly across the entire national network.
Exactly. And it's not just the software either. It's physical real estate. During an integration, you often end up holding dual leases.
Oh, man.
You're paying rent on the old Ecom Express hub while simultaneously paying to expand the nearby delivery hub to absorb the volume. You're paying severance to redundant management while paying overtime to the floor staff trying to physically move the inventory. I mean, their own earnings deck shows 90 crore in pure integration costs just in that Q2 period.
So the Ecom Express merger essentially just cannibalized their Q2 profits completely?
Yes.
But they were also aggressively rolling out an entirely new fleet of electric vehicles at the exact same time, right?
which is a classic conflict between long-term strategy and short-term financial pain. Replacing diesel trucks with EVs drastically lowers your operational expenditure over a 5 to 10-year horizon. The cost per kilometer just plummets.
Right, but buying them.
But the upfront capital expenditure, buying the vehicles, building out the charging infrastructure at all your hubs, it's an immediate, massive drain on your cash flow.
So let me get this straight. They were trying to absorb a competitor, rewrite their software, and transition their entire fleet to a new fuel source simultaneously.
Oh, and didn't they swap out their CFO during this exact same period?
They did, which naturally introduces administrative friction. And if you dig into the segment data from that period, their supply chain services division actually dropped 21% year over year. So while parcel volume went up, their high-margin supply chain management services shrank.
And the financial press absolutely savaged them for it. One metric I saw that triggered a lot of negative sentiment was their return on equity, or ROE. The media weirdly reported that Delivery's ROE sits at an abysmal 1.22%.
That 1.22% figure is incredibly sobering for any institutional investor. It strips away all the hype of drones and SaaS platforms and looks purely at capital efficiency.
Basically, a 1.22% return on deployed equity means that for every 100 rupees of shareholder money they use, they're barely scraping back a single rupee and 22 paise in profit.
You could take that same 100 rupees, put it in a completely risk-free standard bank deposit, and generate a significantly higher return. It essentially implies the core business model is deeply inefficient with capital.
It does. And there's another massive financial cloud hanging over their future valuation. It's kind of buried in the back pages of the earnings report, employee stock options, or ESOPs. The current data shows over 14.2 million unvested ESOPs just waiting in the wings.
14.2 million.
Yeah.
And the trigger mechanics for those options are fascinating because millions of these are performance-based options that only unlock for the executive team if the company's share price hits specific, highly aggressive targets. We're talking 800, 1,000, and 1,200 rupees.
Which, on one hand, you can argue perfectly aligns management's incentives with the shareholders. The executives only get their...
That is a massive dilution event hanging over the heads of current investors. Your slice of the pie instantly gets smaller the moment the company succeeds.
So you have this intense tug-of-war happening. The company is pointing to the Q3 1,000 crore EBITDA milestone and the promise of this beautiful, digitized logistics network. But the media is pointing to the Q2 50 crore integration bloodbath and a 1.22% ROE.
So what does this all mean? How is the actual stock market, the ultimate voting machine, digesting this conflict as of April 2026?
Well, look at the chart.
Yeah, I'm looking at the real-time technical analysis from Zero to Kite right now, and the market seems surprisingly forgiving. The stock is currently trading right around 470 rupees, and the chart is displaying a very strong, undeniable bullish trend.
It really has been a slow, steady grind upward from its lows near 300 last May, and the stock is currently trading comfortably above all its key moving averages, the 20-day, the 50-day, and the 200-day.
And let's translate what that actually means for human behavior in the market. When a stock stays above its 200-day moving average, it means the current price is higher than the average price investors paid over the last year.
Right.
So it means institutional investors aren't underwater, they aren't panicking, and they're basically holding their positions.
Precisely. And the candlestick patterns reinforce that sentiment. The chart shows repeated hammer and engulfing patterns whenever the stock dipped into the 420 to 440 range.
So what does that mean behaviorally?
In behavioral terms, that means every time retail investors got spooked and sold the stock down to 420, massive institutional buyers immediately stepped in and swallowed up those shares, which forced the price right back up.
Wow, okay, so that 420 to 440 zone has become a concrete floor. The buyers simply refuse to let it fall any further.
Yeah, and the momentum indicators back that up entirely. The relative strength index, the RSI, is sitting at 67.73.
Which is an interesting spot, because an RSI over 70 usually triggers algorithmic selling, right? Since the stock is viewed as overbought or overheated.
Correct. So at 67, it is certainly warm, but it primarily signals that there is sustained, powerful buying pressure. Buyers are experiencing a fear of missing out as the company proves it can survive the Ecom Express integration.
Right. The analysts clearly smell blood in the water in a good way. The targets are tightly clustered between 450 and 510, with Kotak planting a flag all the way up at a 570 long-term BUI target.
Yeah, they are very optimistic.
If the stock can break through that immediate psychological ceiling at 490, it really has a clear runway past 500. But and I have to stop right here. I heavily push back on this entire bullish narrative.
Really, the chart looks healthy. What is the hesitation?
The technical chart looks great, yes. The lines are moving up, but the underlying valuation is terrifying.
Ah,
I'm looking at their price-to-earnings ratio, the PE ratio. It is sitting at over a 160x, with some metrics pushing it well past 200x.
yeah, that is steep.
Investors are paying 160 times earnings for a delivery company. They are valuing a company that runs physical trucks, burns physical diesel, and employs 71,000 physical warehouse workers as if it were a high-margin, pure software SaaS company. That is a massive valuation stretch.
This raises an important question, and you are absolutely right to call out the 160x multiple, because the valuation is the single biggest risk factor for delivery right now.
Right.
To offer some perspective, their trailing 12 months profit, the TTM, is sitting at 138 crore. So they have proven they can generate actual sustained profit over a full year, not just during the Q3 Diwali rush.
Sure. But paying 160 times that 138 crore profit implies that the market has completely abandoned reality.
It implies that the market is entirely ignoring the present and pricing in a flawless future. When you buy a stock at a 160x PE, you are not buying the company as it exists today. You are buying the 1,000 crore net profit you assume they will generate 5 years from now.
It leaves absolutely zero margin for error.
None. The valuation assumes that the Ecom Express integration finishes without another 90 crore write-down. It assumes the EV fleet rollout slashes fuel costs exactly as modeled.
Yeah.
And it assumes that Freight Index 1 actually becomes the industry standard OS, and that autonomous drones become a scalable commercial service rather than just a PR start.
Because if they miss just one of those assumptions, like if they hit another Q2-style pothole and lose 50 crore, a stock with a 160x multiple doesn't just dip, it craters.
Exactly.
The market will mercilessly punish a valuation that high if the growth narrative stumbles for even a single quarter.
And that perfect future valuation completely dismisses the fiercely competitive reality of Indian logistics. DELHIVERY isn't operating in a vacuum. You have highly capitalized legacy players desperately modernizing their own tech stacks. You have incredibly agile local startups attacking niche routes.
Right.
And most dangerously, you have massive e-commerce giants like Amazon and Flipkart constantly analyzing whether it's cheaper to just insource their own logistics rather than paying deliveries margins.
Which brings this entire deep dive full circle. When you step back and look at Delivery Limited, you aren't just looking at a company, you are looking at a collision between two fundamentally different worlds. On one side, you have grueling, massive physical scale.
Yeah.
They manage 21.9 million square feet of infrastructure. That's enough warehouse space to cover hundreds of city blocks. They have 71,000 human beings physically lifting boxes, driving trucks, and fighting traffic every single day.
And layered directly on top of that heavy, sweaty reality is a cutting-edge technology firm. A firm building open-source freight APIs, writing algorithms to solve the traveling salesman problem for 500,000 tons of cargo, and launching VTL drones.
And they are achieving massive milestones. Proving they can generate 1,000 crore in service EBITDA is a historic validation of their model. But as we saw with the 50 crore Q2 loss, the friction of forcing the physical world to obey digital algorithms is incredibly expensive.
It really is.
Merging legacy systems, upgrading fleets, and managing human error like a 20 crore typo on a balance sheet, it constantly threatens to derail their high-wire act.
For you, the listener, the takeaway here is critical regardless of your industry. If you are an investor, Delivery is a masterclass in the dangers of a stretched valuation demanding perfect execution. If you are an entrepreneur or operator, their Ecom Express integration is a stark warning about the hidden, devastating costs of merging complex operational systems.
And even if you are just a consumer waiting for a package, Delivery's journey is a real-time reflection of the Indian economy itself. It is digitizing rapidly, it is incredibly ambitious, it occasionally trips over its own massive scale, but it relentlessly forces its way forward.
We are watching the messy, expensive digitization of the physical economy happening in real time.
Which leaves us with one final, a lingering thought to chew on. We spent this deep dive analyzing their tech stack, the 12-minute medical drones, the algorithms, the Freight Index 1 platform.
Yeah.
But if Delivery actually succeeds in making routing completely algorithmic, and if freight pricing becomes 100% transparent and optimized, doesn't the physical act of moving the box just become a race to the bottom? 10 years from now, when you track your package, will the real financial value belong to the physical truck burning tires on the highway? Or will the ultimate profit belong entirely to the lines of code that dictate where that truck goes? Think about who actually holds the power the next time your delivery progress bar stalls. Thanks for exploring the depths with us.